right, welcome to Iron Financial, the channel where we help you forge a stronger portfolio by cutting right through the market noise. Today, let's get right to it. Forget everything you think you know about General Mills being just a food company. We're not here to talk about Cheerios or Pillsbury Dough. Today, we are analyzing a structure, a massive, blue-chip corporate structure that just got rocked by a seismic shockwave after its last earnings report. So the big question, the only question that really matters for investors right now is this. Are we looking at a few surface-level cracks that can be easily patched up, or is the entire foundation of this company about to crumble? We're going to put on our hard hats, we're going to look at the blueprints, and we're going to decide if this is a demolition site or a renovation opportunity. Let's dig in.
So this is it. This is the number that sent the tremors rippling through the market, a 37% drop in adjusted earnings per share. Let's be really clear here. For a company like General Mills, a name that you're supposed to buy for stability, a name that's supposed to be the bedrock of your portfolio, well, this isn't just a little wobble. This is a massive stress fracture. It's the kind of number that sends a shockwave through your holdings and makes you stop and ask, what in the world just happened? A 37% hit to your profitability is a major blow, and our job today is to figure out exactly what caused it, and more importantly, if the structure can even handle that kind of impact.
You know, the folks over at Jefferies, they didn't mince words about it. Yeah, they basically said a volatile Q3 does little to provide clarity. And I mean, come on, that's just Wall Street speak for we have no idea what's really going on here. And that's the heart of the problem, isn't it? Is this just a one-off, a temporary crack from one bad quarter that everyone's going to forget about in 6 months? Or, and this is the scary part, is this the first visible symptom of a much deeper, more dangerous structural decay that's been hiding just beneath the surface? That's what we have to find out. That's the real risk.
Okay, so to get to the bottom of this, we need a game plan. Here's our blueprint for today's analysis. First up, we're going to sift through the initial damage report in A Titan Takes a Hit. Then we get to my favorite part, where we'll examine every single crack we can find in the bear case. After that, we'll see if management has a credible plan to fix things in the bull case. Then we get to the main event, the reason many of you are probably here, the 6.3% dividend dilemma. And finally, we'll wrap it all up and deliver our verdict. Is this thing a solid structure or just a pile of rubble?
All right, let's get into it. Section 1. A Titan Takes a Hit. Look, before we can even begin to think about the long-term integrity of this company, we have to deconstruct the initial damage report. We've got to sift through the wreckage of this Q3 announcement and understand exactly what happened, where the impact was felt the hardest, and what the immediate fallout looks like. This is ground zero for our investigation.
Okay, so let's get down to the hard numbers. This is what the damage report actually says. On the bottom line, adjusted earnings per share came in at 64 cents. Now, Wall Street was geared up for 73 cents. That's a 9-cent miss. That's not small. That's a significant miss. Then you look at the top line, revenue. They brought in $4.40 billion, when the expectation was just a hair higher at $4.41 billion. Now look, these are not rounding errors or some kind of statistical noise. This is a clean miss on both fronts. It shows weakness starting at the very top with sales and filtering all the way down to the actual profits. It's not a good look at all.
So, of course, management came out with their list of reasons for the poor performance. They're pointing the finger at things like strategic reinvestments, selling off their yogurt business, retailers cutting back on inventory, even the weather. You know, the usual suspects. Whoa, hold on a second. We really have to push back on this. The question you have to ask is, are these legitimate, unavoidable operational pressures, or are these just excuses for poor execution? I mean, strategic reinvestments is just another way of saying we spent a bunch more money. A truly solid company, a fortress of a company, should be able to weather these kinds of storms, right? To me, this doesn't sound like resilience. It sounds like they're telling us their whole structure isn't nearly as strong as we thought it was.
Okay, time for my favorite part, Section 2, the bear case. We're putting on our hard hats, we're grabbing our flashlights, and we are going down into the basement of this company to find every single crack in its foundation. We are going to stress test this whole thing from top to bottom, because this is how you find out if you're dealing with solid steel and concrete or just a pretty facade that's hiding a ton of rot.
And boom, here it is. The first massive, undeniable crack in the foundation. A 420 basis point drop in their adjusted operating profit margin. Let me translate that from Wall Street jargon because this is incredibly important. That's a 4.2 percentage point drop. Their ability to turn sales into actual profit literally fell off a cliff in a single quarter. It went from a respectable 16.5% all the way down to just over 12%. I mean, that's not a dip. That is not a gentle slide. That is a catastrophic collapse in the company's core profitability. And when a pillar of that importance starts to crumble that fast, you have to seriously question the entire building.
So, you've got to ask yourself, why did the profits collapse so dramatically? Well, this chart tells the whole ugly story. First, look at volume. Organic pound volume, that's just a fancy way of saying the actual amount of stuff they sold, was down 2%. So people are literally buying fewer boxes of Cheerios and less Pillsbury dough. But it gets worse. Look at price and mix. That was negative 1%. That means that for the stuff they did manage to sell, they were getting less money for it. Let that sink in for a second. You're selling less product, and you're getting paid less for each item you sell. That is a brutal 1-2 punch. It forces you to ask a really uncomfortable question. Are these iconic, powerhouse brands starting to lose their grip on the customer?
But this right here, this might just be the ballgame. This is the weight that could bring the whole structure crashing down. Just look at this comparison. On one side of the balance sheet, you have almost 24 times billion dollars in total liabilities. That is a mountain of debt. It's a massive, crushing weight. And what do they have to support that mountain? A measly $683 million in cash on hand. The ratio is it's staggering. It's like trying to hold up a skyscraper with a toothpick. How on earth are you supposed to handle any unexpected problems, any new cracks that appear, when you're carrying that much weight with so little of a safety net? For the bears, this is it. This is the smoking gun.
Okay, I hear the bears loud and clear, and those are serious points. But a proper analysis, a true structural assessment, can't just focus on the damage. You also have to look at the crew that's been called in to fix the problems. So let's switch gears and look at the bull case. The damage is absolutely real, we've established that. But the bull argument is that management has a credible plan, a blueprint for the rebuild, and they're already getting to work. So let's take a hard look at that plan.
And this is the first thing the bulls will point to. This is Exhibit A, that the repair work might actually be taking hold. Just look at the trend here. For all of last fiscal year, their U.S. retail volume was just bleeding out, down a painful 7%. But fast forward to this last quarter, the one we've been talking so much about, and that decline slowed all the way down to just 1%. That is a huge improvement, a 6 percentage point swing in the right direction. This shows they're stopping the bleeding. The crazy downward momentum has been arrested, and that's always the first step to stabilizing the whole structure. So what's the secret sauce here? Well, according to management, it's something they're calling their Remarkability Playbook. Oh, give me a break. Remarkability? Here we go with the corporate buzzword bingo. What does that even mean in the real world? Look, I get it. The skepticism is absolutely warranted. It sounds like something straight out of a marketing meeting. But we have to dig past the name. They're saying it's a real plan, an engineering blueprint focused on 5 specific things: better products, better packaging, better communication, and so on. And here's the thing. They have a number to back it up. They're touting a 25% jump in sales from new products compared to last year. Now, that's not just jargon. That's a tangible result. It suggests that at least one part of this playbook is actually working.
And looking ahead, management says they're not just crossing their fingers and hoping for the best. They've laid out some very specific reasons why they expect the fourth quarter to be much better. They're talking about favorable timing on some expenses, the simple fact that there's an extra week in this fiscal year, which always helps, and they expect some of those retailer inventory issues to reverse and actually become a tailwind. Plus, they believe their market share performance will stay strong. The point is, this isn't some vague promise of things will get better. They're pointing to concrete, measurable factors that they believe will get them back on solid footing. And all of this, the cracks, the rebuild plan, it all leads us here, to the main event, that eye-popping 6.3% dividend yield. Let's be honest, for a lot of investors, this is the only reason we're even having this conversation right now. Yeah, and it's either the deal of a lifetime or a complete trap. So, is that 6.3% a reward for being smart enough to see the turnaround coming and having the guts to invest? Or is it a giant, flashing neon sign warning you to stay away because the foundation is about to give out? This is the core dilemma.
Okay, I'll go first. From where I'm sitting, this thing is screaming trap. I mean, just look at the evidence. We just saw that crushing debt load. The core business is shrinking. Both revenue and profits are going in the wrong direction. Even worse, their free cash flow, the actual cash they used to pay the dividend, dipped below 1 in the second quarter, which means they were paying out more than they were taking in. And the last time they raised the dividend, it was a tiny, pathetic 2% bump. That tells me everything I need to know. Even they're nervous. The structure is groaning under the weight of its own payout. But you have to see the other side. The bull case here is that this is a reward for your patience and for taking a calculated risk. You simply cannot ignore a 6.3% yield in this market. And remember, this company is a dividend aristocrat. That means over 25 straight years of raising their dividend through good times and bad. That's a serious track record of structural integrity.
And maybe most importantly, management just got on their quarterly call and explicitly said they are committed to the current payment. They insist the full-year cash flow is still manageable. The bulls see this as being paid handsomely to wait for the renovation to be completed.
All right, it's time to put it all together. We've inspected the damage. We've heard the bears' warnings loud and clear. We've looked at the bulls' blueprint for a rebuild. Now, we have to step back, look at the whole picture, and make a call. It's time for the final iron financial verdict. So what is it? A fixer-upper with good bones and a lot of potential? Or is it a total teardown that's beyond repair? Let's land this plane. Okay, our final verdict really boils down to a simple three-step logic, so let's walk through it together. Step 1, the damage is absolutely real. Yeah, there is no sugarcoating this. That 37% drop in profit, that massive 420 basis point margin compression, that was a major structural failure in the quarter. You can't just pretend those cracks aren't there. They are deep and they are real. Completely agree. But that brings us to step 2. The blueprint is also there. You have to acknowledge that management isn't just sitting on their hands. They have a clear plan, this whole Remarkability playbook, and we are seeing early signs, specifically in those improving volume trends, that it's starting to gain some traction. The repair crew is on site and it looks like they're making progress, which really brings us to the bottom line, the investment thesis in step 3. Exactly. So here it is, the final call. If you buy General Mills stock today, you are not buying a safe, stable, predictable food company. You are making a very specific bet. You are betting that management's turnaround plan will work, and that it will work well enough and fast enough to overcome that mountain of debt and those ongoing profitability pressures. Plain and simple, it is a bet on the rebuild.
And that brings us to our final thought. And this question isn't really about General Mills. It's about you and it's about your portfolio. Look, a turnaround story like this is a construction site. It's messy, it's going to be noisy, and there is a very real risk that the whole renovation project could fail. The potential reward is obvious. You get that huge 6.3% yield while you wait, and you get all the upside if the stock recovers. But the risk, the chance that it all falls apart, is just as real. So the question you need to ask yourself is this: is my portfolio built to withstand this kind of volatility? Do I have the risk tolerance to handle the heavy lifting that comes with a bet like this? Because answering that question is the only way you'll know if this is an opportunity that you are willing to build on.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.